Welcome back. Tactical Futures, session number 2. Today we're going to talk about the uses and history of futures. You know, futures, like we talked about in the last session, they're not brand new. They've been around for a while. So, what we're going to do is we're going to watch a short video in this session on the history of futures and really where futures came from. So, let's go ahead and start with the history of futures, and then we'll come back and talk about the uses of futures.
When you're in there from 8:30 to 3:15, it's all about money. One guy's misery is one guy's, profit. Sad to say, but that's true. Not that I take advantage of that, but maybe I would.
By the middle of the 19th century, Chicago was emerging as the transportation hub of America. Trade routes by rail and water converged on the city, giving birth to its famous stockyards and slaughterhouses, and a town hall market that would later become known as the world's first modern futures exchange. On April 3rd, 1848, 83 merchants founded the Chicago Board of Trade. Futures trading provided an opportunity for buyers and sellers to manage their risk against unpredictable price fluctuations. Too many cattle this year? Well, the beef prices are low. Drought in the Midwest? The corn prices go higher. If both the buyer and the seller can agree on a price ahead of time, we call this a futures contract. This agreement allows them the opportunity to protect themselves against paying too much or selling for too little. So who are all these guys yelling and screaming, and what are they doing? As the exchange grew in popularity, at times there'd be more sellers than buyers, or a demand with no one there to meet it. Entrepreneurs saw an opportunity to take advantage of this imbalance, working in the middle as both buyer and seller. This allowed them to profit by speculating with their own money while filling a vital need for market liquidity, or the ease with which goods can be bought or sold in the marketplace. These early speculators became known as local traders. As their role expanded over time, they became major players on the trading floor. In 1981, the Chicago Exchanges introduced metals, energy, currencies, bonds, and stock indexes, attracting more interest than ever before. Soon, calls were coming in from all over the world. The modern local trader might trade hundreds, if not thousands, of contracts in a single day, often getting in and out of trades in seconds, each time risking their own money in the hopes of profiting as they hold their own against the expanding market.
All right, welcome back. So that was a pretty interesting video and a pretty interesting concept about, where futures markets came from and how they were started. But let's talk about how we use them today. And really, futures are used for two distinct groups: hedging and speculating, right? Hedging and speculating. So hedging, it's using futures to protect against price fluctuations of underlying assets. Speculating is using futures as a vehicle to capitalize on the price movements of an underlying asset for the purposes of making a profit. So when we think about hedging and speculating, they're two very different purposes, but both can be used. So let's go ahead and start with talking about the hedging uses of futures. Now remember, a hedge is essentially an insurance policy, right? So when we talk about hedging, what we're really talking about is an insurance policy. And let's first talk about it from the perspective of a producer. So what is a producer? A producer is somebody who makes raw materials. So let's talk about the farmer. So here's Farmer Joe. This farmer knows how much wheat he plans to plant on that season. He knows how much he plans on planting. He knows when that wheat will be ready for harvest, because there's a known schedule attached with the growing season. What doesn't he know? Well, he doesn't know how much wheat he'll grow, right? It could be a dry season. It could be a wet season. Something could happen. He doesn't know what the cost of it is going to be in the coming few months. So this particular user, the producer, wants to be able to sell the wheat, but he or she doesn't know how much they're going to be able to sell it for. So the farmer's not going to receive payment until harvest, and someone decides to buy their crops. So what the farmer can do is offset the risk of a decline in the price of wheat between planting and harvest by selling a futures contract. So if the current price of wheat is higher today than it is in the future, the farmer's not going to make as much as he could have. If the current price of wheat in the future is lower than it is today, the farmer is going to make out. What the farmer does when they sell a futures contract is they're locking in how much they're going to receive for that wheat upon production. Now, because the farmer sold this contract, that farmer is now obligated to provide the wheat to the buyer, right? So the buyer is obligated to take the wheat, and the farmer is obligated to provide the wheat. The farmer is selling the futures contract to the buyer. All right. Now, and that contract is facilitated at an exchange. So if price declines during this period, the farmer will not be able to sell his wheat as much as anticipated. However, that loss is offset by the short position in wheat futures. Right? In this case, because the farmer sold the wheat, he is in a short position, right? And the value of the contract would go up, right, as the value of the wheat goes down. So that contract is now hedged. That when that farmer sells the wheat, they're going to lose. They're not going to make as much on the wheat as they would like to, but they're going to have sold it for that contract position. So as a producer, these make a lot of sense, right? If you're a farmer, you want to know how much I can make. Matter of fact, you actually get the money ahead of time, right? You get the money ahead of time, a small amount of the money ahead of time in the form of a deposit, right? That might be where the term seed money comes from. You think about the term seed money, you get the money up front to buy the seeds to plant the crops. So that is from the perspective of the producer. Let's talk about the hedging concept from the prospect of the consumer, somebody who's actually using the raw material. And this happens a lot. So let's say that we're talking about a home builder. And a home builder buys a tract of land and anticipates building 500 homes. So when we think about the building of homes on this tract of land, what is the most expensive raw material for that home builder? Well, it's probably lumber, right? It's probably lumber. Well, that developer pre-sells the home sites and the homes that are going to be built. The home builder's single most expensive raw material is going to be the cost of lumber. So how does that home builder offset the cost of lumber? Well, in order to offset the cost of lumber, he will go out and buy, lumber contracts. He'll go out and buy lumber contracts, because if the value of that lumber contract goes up, it's because the cost of lumber has also gone up. So when you think about it as a home builder, you know how much you're selling the house for before you sell the house. The big risk is the cost of lumber. So by buying the lumber futures contract, what happens is if the price of that lumber rises, the profit of that land home builder is going to drop. Well, the drop in the profit, because he pre-sold the home sites, the drop in the profit is offset by the rise of the futures contract. So the use of the futures contract allows the consumer to lock in the purchase price of a raw material. So thinking about it from a consumer standpoint, it allows the consumer to lock in the purchase price of a raw material. From a producer standpoint, it allows the producer to lock in the sales price of a raw material. So what about an investor? How does an investor hedge with futures? So let's say that we have an investor who holds long positions. And these long positions are positions that they don't want to liquidate in the event of a market decline. So maybe they have long-term dividend stocks, or positions that they don't want to close out for tax reasons, any other reason that they might have. And they look at the market, and the investor sees that we have a rising stock market, but we're rising on lower momentum. And so the market is rising on lower momentum. And so there's a catalyst that may drive the market lower in the short or intermediate term. So as an investor, what I can do is keep my long positions intact, stay in the long positions. But at the same time, short an equity futures contract, right? So maybe this is the S&P we're looking at. Maybe the investor can short the S&P futures contract. Now, that means that if the market goes down, all those investments are going to lose money for the most part, but the short contract will gain money. And so the idea is that the money that is lost, if the market falls, the value of the investor's portfolio will drop. The value of the short futures contract will rise and can act as a hedge against the long equity positions. This allows a longer term investor to stay in positions when there are fairly substantial pullbacks. Now, as an investor, you can keep that hedge, or you can close out of that hedge at a certain point when you think the markets are going to start to come back up, allowing you to capture that bit of profit as it came down. So this is utilizing futures as an investor to hedge positions. Similarly, if you were in a short position, you could buy futures contracts as a protection. So those are really the way that we talk about a hedging, right? The other, which is probably the most common and what we're going to focus on in this class, is utilizing futures in a speculative sense. Speculating is using futures as a vehicle to capitalize on the price movements of an underlying asset for the purposes of making a profit. So as a speculator, I'm going to be looking at charts in a small time frame. Here's a picture from our live trade room. In this live trade room, we see that there was a possible long entry at 39.29. And that long entry we had at 39.29 was if price drops into this area, there's a reversal trade, because we had a little area where there was a base rally above a pivot low on a 15-minute chart. We know that it's a 15-minute chart because it's in a purple lined area. So that was the setup of the trade. Now the result is the price moved down and touched the zone, giving us an entry. And then price eventually moved to 39.59. So it was a pretty strong 30-point move from 39.29 to 39.59. Now, looking at the S&P, the way we look at the S&P is that the S&P is the contract size. We talked about speculations. It's $50 times the number of S&P index points. The minimum tick is 0.25. So there's 4 ticks per point. Every time the S&P moves up 1 point, it also moves up 4 ticks. Well, because 1 point is $50, $50 times the S&P index is 1 point, each tick is $12.50. This is a 24-hour traded market. It trades essentially Sunday 5 p.m. to Friday at 4 p.m. Central Time. Trading halts each day for about 15 minutes, but basically it's a 24-hour-a-day market. This 24-hour market really allows a trader or an investor the ability to take advantage of market movements in an overnight session. So if we look at this position and we say, well, from 39.29 times 50, that means that this contract is controlling $196,450 worth of the S&P. And if we sell at 39.59, that means we're selling at $197,950. That's where we sell. So the profit on this particular position is $1,500. So we've got $196,000 to profit for $1,500. Is that a good use of capital? Is it a good use of capital if we use $196,450 to make $1,500? So looking back at this, we were only in this trade for less than a day. This particular trade had an entry Monday in the overnight sessions, and it hit its target by about 8 a.m. the next morning. So it's just a few hours. Is it a good trade to make 0.76% rate of return in just a few hours? Well, is that a good use of capital, though? I mean, do most people have $196,450 to put into a trade? So how is that a good use of capital? Well, the reason it's a good use of capital is because of margin. Margins will allow you to control $196,000 worth of futures for as little as $500 per contract. Now, that's going to be very dependent upon the exchange and the broker. So I don't want to say that every broker is going to be that much, and I'm giving you the smallest amount that I've seen in the brokerage firms. There are other ones that are out there, but we're going to cover that a little bit later on when we have a whole class just on margins. The point being is that margin allows you to control $196,000 worth of an asset for as little as $500 a contract. So if I'm using this as a speculative investor, I'm going to have to understand that margin is a key. But remember this, margin cuts both ways. When you use margin, proper risk management and risk analysis are more important than ever. The additional leverage that's created through the use of margin is something that everybody needs to be aware of. And so we don't use margin unless we understand the risks associated with it. Our next session, we're going to talk a little bit more about, contract specifications and futures and how we find them and how they're traded. But remember, we're going to have a whole session on margin. You've got to understand the margin of the asset you're trading. But futures give you the ability to control a large amount of capital, but only use a small amount of capital. So if you have any questions, as always, send us an email, support@tradersarmy.com, or shoot us a text. We're here. See you in the next session.